Hi, welcome to the Let's Talk Forex podcast. Last week we spoke about expert advisors and indicators, so if you haven't listened to that one, go back and take a listen. This week we are taking a deep dive into timeframes and timeframe analysis. Enjoy.
Hey Alison, how are you today?
Yeah, I'm good. How are you doing, Chris?
Yeah, not too bad at all. Not too bad
Cool.
at all. You've been watching the markets?
Yeah, SVB's thrown quite a curveball into the markets this week, I think.
Yeah, they have. It's been pretty crazy. And we've got the Fed meeting. We're recording this on Tuesday, 21st of March, and I know the Fed's meeting today and tomorrow. So they're what they decide to do with interest rates. I think the whole world is holding their breath at the moment and waiting to see.
Yeah. Yeah, it'll be interesting if they sort of keep to their word, with the 50 or the 25 basis points, we'll have to see.
It is, as Chris Weston was talking about, a couple episodes ago. We're probably looking at some pretty crazy volatility coming up, which is good for forex traders.
It is, yeah. Yeah. At
Yeah,
least some people can take advantage of that.
yeah, exactly. Well placed. We're well placed to take advantage.
Yeah.
But we're not talking about that. We're talking about timeframes, which may not be the sexy topic on the face of it, but it's actually really important. So yeah, let's get into it. What are timeframes? If you've spent any time around forex trading and you've opened a chart, then you probably know what a time frame is. At most basic level, it's a period of time where price movements take place. It's anywhere from a few seconds to minutes, hours, weeks, or even months. So if you're on your chart and you move it to the 1 minute time frame, it means that you're tracking the movement of a price of an asset across that minute, and it will update every minute. The most common time frames are 1 minute, 15-minute, 30-minute, 1 hour, 4 hours, daily, and weekly. But there's many more out there as well, and you can, on most good charting applications, whether you're an MT4 or an MT5 or C-Trader or whatever you use as a trading platform, you can switch between them pretty freely. Timeframes are essential for decision making because they give you information about the strength and the direction of trends that you can see in the market. This is because when you switch a time frame, the whole point of switching it is that you use that time frame to carry out analysis, using that time frame as a guide. And the aim here is to establish whether there are any notable trends over the course of that time frame.
And I think for a lot of beginners, they will be wondering which time frame is the best for trading. And that's actually not an easy question to answer because, as with everything, it depends. And the chart time frames that you will use also depend on the assets that you're trading. So the best time frame for Forex could be quite different for the best time frame to trade stocks, for example.
Mm-hmm.
And they'll also depend on the type of trading strategy you use. So a positional trader is less likely to, or is more likely to hold positions for longer than a day trader. And they'll be looking at much longer timeframes, like you were mentioning the weekly and the monthly timeframes, for example.
Mm-hmm.
And a day trader won't, we've spoken about day trading in previous episodes, they won't hold a position overnight, and they aim to make multiple trades per day or even per hour. So they may choose timeframes that last, say, 15 minutes or less. So essentially, the objective of choosing a time frame is choosing one that fits your trading strategy and your assets. And as you were saying just now, that when you put timeframes together with other metrics, like, for example, support and resistance lines or breakout points, chart patterns, and different trends, then you'll get a much better idea of how an asset's price is trending, or what's going to happen with that asset price.
Yeah, so choosing the right time frame for you, I mean, it kind of depends on your personality and your availability as a trader. Do you like to take things slow? Do you like to take your time in each trade, or do you prefer like really fast-paced action trading? Do you have the time to watch charts during the day, or do you have a full-time job and you can only check on your trades once or twice a day?
Yeah.
Another factor to consider is how much capital you have. So longer time frames, they're going to require larger stops at the end, and so you're going to need a bigger account because there's going to be larger swings in the price movement over larger time frames. So you need to have that larger account. You need to have those larger stops so you can take on those swings without facing a margin call. While if you're going to trade with shorter time frames, you can use higher margin and your stop losses can be much tighter. Lastly, another thing to consider when you're thinking about which time frame to use is if you're trading longer time frames, you won't have to pay as many transaction fees like spreads or commissions because you aren't opening and closing lots of trades during the day. But you will have to consider overnight swap fees, especially if you're using leverage or high levels of leverage. Those can really bite into your profits.
I do.
Whereas day traders or scalpers will have to pay spreads and commission or both each time they open or close a trade, but then they're less likely to pay the overnight fees because they're not holding positions overnight. So those are the kind of things you have to think about when you're considering what time frame you want to use for trading.
Yeah, and scalping, as you mentioned, scalping uses very short-term time frames, sometimes from seconds to minutes, up to 15 minutes. And the best scalping time frame and most commonly used by most scalpers is sort of 1 to 2 minute time frames. And if you're a day trader, you're going to be using 15-minute time frames because you're going to obviously aim to enter and exit the trades many times per hour or per day. And what day traders also do is that they look at the primary market trend over 60-minute time frames. And then from there, they can find suitable entry and exit points at the 15-minute time frames, for the shorter trends.
Yeah, they use multiple time frame analysis, which is something we're going to come on to towards the end of this episode. Another common trading strategy is swing trading. So you're looking to capitalize on short and medium term trends. And the best time frame for swing trading is short term. So based on movements of an asset price, usually every 4 hours. And these 4-hour charts can be used in conjunction as well, like day trading with longer time frames, usually spanning a few days. So you can make sure that the trend that you're seeing is actually panning out the way you expect.
Mm.
And the last, major form of trading strategy is position trading, and this has obviously got a much longer term focus. Position traders, you find an asset that's going to appreciate in value or depreciate in value over a long period of time, usually weeks, months, sometimes even years. So the best time frames for this type of trading usually span the course of a day or a week. And in general, you can look at daily prices, and then you can take a broader overview by looking at price changes over the span of a few weeks in order to get, so you want to have a really good idea of the long-term support and resistance levels before you set your stops.
Yeah, and before you decide, I guess, which direction as well. So with all trading strategies, you want to perform multiple time frame analysis. So you don't just want to focus on the very short or long time frame you're looking at, because you want to get a very good overview of the assets that you're trading. And it'll also it'll help you find as many trading opportunities as possible. So most traders start by choosing one longer time frame and then another shorter time frame. And generally, traders use a ratio of 1 to 4 or 1 to 6 when performing time frame analysis. And this means that the 4 or 6 hour chart is used as the longer time frame, and then the 1 hour chart is used as the lower time frame. And this is particularly for scalpers or for day traders. And then the longer time frame can be used to find the trend, and then the shorter time frame can be used to identify those entry and exit points. And the beauty of this approach is that technical analysis can be applied to both time frames, and then you can achieve a greater conviction for the trade and for your entry or exit points.
Yeah, so when you're zoomed out and you're looking for the trend, as it were, the technical analysis stuff you need to be thinking about is you need to understand and identify Forex trend lines. A very good indicator is a 200-day moving average, especially if you're using the daily time frame. And then the moving average, convergence, divergence. These are going to give you a good idea of longer term trends before you go in, you zoom in and you establish your entry levels. When you're zoomed in on the time frame where you're actually going to make your execution, you want to be looking at the moving average crossovers. You want to be conducting some pretty serious candlestick analysis for volatility. And you want to make sure that your support and resistance levels are accurate. Indicators that are very useful here are the RSI and again the MACD and stochastic oscillator. These are all very helpful for identifying entry points. It can also be used. Multiple time frame analysis can also be used to help you manage several trading positions at one time without increasing your risk too much. So it's really is if you're a regular day trader, you're going to be making multiple trades a day, then this is something you really need to integrate into your trading style.
Yeah. So how do you then perform a multi-time frame analysis? So if we look at it step by step, and this is particularly for a day trader, you don't need to get too fancy, but you have to know how to do it and how to approach it so that you can build a time effective routine that guides you through these sessions. So firstly, you want to start looking at your weekly charts. So if you mainly use the 4 hour or 1 hour timeframes to execute your trades, you don't have to spend too much time here, but you just want to get a feel for the overall market direction and know if there are any major price levels ahead. So especially looking at long-term support and resistance or your weekly or annual highs and lows, these are the things you want to mark on your charts. Once you've sort of had a zoom out, if you want to put it that way, then you zoom back into your daily chart. So on the daily chart, then you can spend a little bit more time here. So here you'll analyze the market direction for the week ahead. Using the indicator you spoke about above, Chris, you're going to then determine your potential trade areas. So you'll want to draw your support and resistance lines, and then you want to mark your swing highs and your swing lows, even if you don't use them in your trading. It's still worth having them on your charts because they are so commonly used, and they will give you some good information about what could potentially happen on the charts.
Yeah, exactly. And then once you've done that and you've got an idea of strategy in your head, then you want to zoom in again a bit closer to as you said, either the 4 hour or the 1 hour, and now you want to think about execution. And this is where you map out your trades and your specific trade scenarios. So you take the levels and the ideas that you came up in the daily time frame, and then you want to translate them into actionable trade scenarios on this tighter time frame, whether it's 1 hour or a 4 hour. Always create long and short trade scenarios when doing this. This keeps you open-minded and avoids one-dimensional thinking. Don't assume the market direction before you're actually putting your trade scenarios together. Be guided by the technical analysis and let that inform your decision making. A trader who's only looking for short trades and blanks out all signals that point to a long trade, or vice versa, you're going to miss the signals that could signal a reversal. It's just a psychological mindset. And separate your charting from your trading platform, which is something I know a lot of good traders do. So if you can see your open orders on your screens while you're analyzing, you're much more likely to add bias, an emotional bias to your analysis.
That's a very good point. And yeah, so if we had to sum it up, you basically, time frame analysis is very important for forex traders. And as we mentioned earlier, different trading strategies work best in specific time frames. Whether you're scalping or day trading, or your swing or positional trading, it'll determine which time frames you'll look at. Scalpers obviously use the shortest time frames. Day traders use time frames of 4 to 6 hours within the forex market trading hours. They don't hold positions overnight. And swing traders benefit from even longer time frames, and they often use a lot more analysis and take a lot more information into account before placing a trade. And then position traders obviously hold their positions for much longer, for several months at a time, but they often have more capital to be able to withstand the highs and lows of the market so they don't get stopped out. And multiple time frame analysis helps traders to identify trends and then identify ideal entry and exit points. But you'll have to, as we said, you're going to have to take a longer view and then zoom down into your specific time frame that you're trading to make the best possible trading decisions.
Yeah, exactly. And yeah, time frame. What time frame you use is really going to be down to you as a person. How much
Yeah.
time you have. But the good thing is that there's, depending on how much time you have, there's a time frame for all traders.
Yeah.
If you don't have that much time, you can be a position trader and you can look at daily or weekly. If you've got lots of time and you love the fast-paced action, sure, get down into the 1 minute charts, and scalp. But yeah, use your multiple time frame analysis, as you said, Alison, and make sure your technical analysis is sound, whichever time frame you decide to use, and you'll be fine. And again, always use a demo account first. Have a look at this, spend some time in the demo account, find what feels comfortable for you. Because even if you do have lots of time, let's say you've got lots of time in your hands and you think you're a good scalper, maybe you just don't have the risk appetite for it.
Yeah.
And so that's okay. Maybe you're going to be more comfortable in the 1 hour or the 4 hour charts. So yeah, take your time. Take your time until you get it right.
Yeah, well, I think that about covers it, Chris. And next week we are going to be talking about.
What are we talking about next week? I've completely
Money.
forgotten.
Me too. I'm just going up to
What are
the
we
top.
talking about next week? What did we pencil in? Professional podcasters. Oh yeah, we're talking about the NFP, aren't we?
Yes.
Interesting. Yeah, good timing.
Yes.
Very good timing. Yeah, we're going to be talking about the NFP, the non-farm payroll. Yeah, and how it affects the market, specifically the Euro USD, but pretty much anything, any currency pair that involves the USD. Yeah, that'll be interesting, and especially in light of inflation and what's happening in the United States right now.
Yeah, absolutely.
Yeah,
Yeah,
that'll be a fun one.
it will be
Cool.
fun.
I look forward to speaking to you then, Alison.
Yeah, thanks, Chris. Chat to you then.
Bye.
Bye.